Does investing in the Tata AIA Smart Sampoorna Rakshak Pro plan offer you comprehensive protection and growth in one plan? Let us find out through an in-depth analysis in this video. Hi there, welcome back to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand a few basic details about it. This is an unit-linked, non-participating individual life insurance plan. Some of the key features of the policy are it offers high sum assured to secure your loved ones from unforeseen events, and it also gets you flexible premium payment term with an option of whole life coverage, and there are two plan options available, which are classic option and optima option, and it is customizable to exactly align with your future goals. And you can also choose from a range of debt and equity oriented funds, and you get to generate a second income with new partial withdrawal strategies, and there is a return of 2x premium allocation charges and 2x mortality charges, and there are smart lady benefits for female customers. So these are some of the features of the policy. There are benefits like maturity benefit and death benefit, loyalty additions and fund boosters, and also there are 25 investment options and 3 investment strategies which you can choose according to your risk tolerance and life goals and choose to invest through it. So these are some of the benefits available under this policy. But as a ULIP policy, there are also various charges which, compared to other ULIP plans available in the market, this policy has relatively fewer charges, but still the presence of discontinuance charge, policy administration charge and premium allocation charge makes the plan less attractive compared to other market related instruments. As comparatively, if you take for a long term period, they will deduct these charges from your premium and then only they will invest your premium. So already the investable amount is lower, and for a long term period the returns will be affected significantly because all your premiums are deducted for these charges. So you need to consider this as a drawback and decide whether investing in this is worth it or not. And if you want to know more about these features of the policy in detail, you can refer to the policy brochure. Now let us take a look at the advantages. So the systematic withdrawal facility allows the policyholder to withdraw the funds at predetermined intervals, and you can choose either a chosen rate withdrawal plan or an index based withdrawal plan for withdrawing funds, and you have the flexibility to pay additional premiums as a top up premium, and the sum assured will increase accordingly. You also have the option to receive the maturity benefit either in lump sum or in the form of periodical payments over a settlement period of 5 years. So these are some of the advantages. The disadvantages, however, are a loan facility is not available. The lock-in period is 5 years for this policy, and during the settlement term, this policyholder bears the investment risk in the investment portfolio. So these are some of the drawbacks that you need to keep in your mind before deciding to invest in this policy. Now, as we have a basic understanding about this policy, let us move on to the analysis part of the video, where we are going to analyze the IRR of this policy based on the benefit illustration given in the policy brochure. So to calculate the internal rate of return of this policy, let us now assume for calculation purpose that a 35-year-old male has purchased this policy with a sum assured of 1 crore. The policy term is 50 years and the premium paying term is 15 years with an annual premium of 81,301 rupees. So the policyholder here has opted for the classic option. At the end of the policy term, the policyholder is eligible for the maturity benefit, which is the fund value. So here we have calculated the returns based on two assumed rate of future investment return, like 4% per annum and 8% per annum, just to show you how as a market linked policy with market risk involved in it, we are going to show you the two extremes it can perform in. whether it can be a worst case scenario or in a best case scenario. That's why we are going to calculate it in 4% per annum and 8% per annum. Two scenarios here. These rates are not guaranteed and they do not represent the upper or lower limits of potential returns you can get from this policy, because the actual returns will vary and completely depend on various factors, including the future investment performance of the policy. So in a 4% return scenario, the fund value here is 18.74 lakhs, yielding an IRR of 1%, which essentially provides no value addition. This is the worst case scenario. In an 8% return scenario, the fund value is 1.39 crores, yielding an IRR of 5.75% as per the policy's maturity calculator. Although the policy term under the plan is 50 years, the returns are not favorable for a long-term investment. Over time, inflation will increase the cost of your life goals, while the returns from this policy may not keep up pace with inflation. This indicates a potential shortfall in the required corpus if you choose the Tata policy. So, as this policy is not giving us the desirable outcome we need and is not giving us a better risk-adjusted return for the amount of risk and the time horizon we have invested in it, let us now explore an alternative strategy in this comparative analysis. So, in this alternative strategy, we are going to invest in insurance and investment separately, because ULIPs combine insurance and investment, but separating the two can be more beneficial, which you are going to find out through this example scenario. So using the same metrics from the previous example, let's examine a different alternative strategy. So for life cover purpose, we have opted for a pure term life insurance policy with a sum assured of 1 crore, which will only cost an annual premium of 25,200 rupees. The policy term is 30 years, which means it gives coverage till 65 years age with a premium paying term of 15 years. So life coverage till your retirement is not recommended in personal finance. So we have considered the policy term as 30 years instead of 50 years. And after paying the premium, you have 56,101 rupees left for investment, which can be allocated based on your personal risk tolerance. Here we have chosen an equity instrument, the ELSS fund, which is also a market linked product. After the initial investment period of 15 years, the fund is allowed to grow. So the final pre-tax maturity value is 12.36 crores. After accounting for capital gains tax, the final maturity amount is 10.83 crores with an IRR of 10.7%, which is calculated on the post-tax return. So if you have any doubts regarding how the ELSS tax is calculated, we do have a small tabular column presented on the screen for your easy reference, which you can pause and see. So for comparison purposes, we have allowed the fund to grow until the age of 85 years. Alternatively, you have the flexibility to withdraw the funds as needed without any restrictions. And the returns are also far superior compared to the Tata AIA policy. So the liquidity and inflation beating returns are significant advantages over the Tata AIA policy. So what is the final verdict then? Is investing in the Tata AIA Smart Sampoorna Rakshak Pro plan worth it or not? So this policy offers you life cover protection and market linked investment opportunities. However, the high premium includes many charges for policy operations, reducing the net amount invested in the market over the long run. This results in below average returns. While the life cover is adequate, the investment aspect of the Tata AIA policy is unsatisfactory, and also it has a high agent commission. Long-term investment should facilitate wealth accumulation, but this plan falls short, making it an unfit investment option. For an affordable premium and adequate life cover, consider a pure term life insurance policy. This provides a safety net and peace of mind. Investments for life goals should be chosen prudently based on your risk tolerance level. Selecting appropriate investment products keeps your financial plan on track.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, We also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.